Imagine a world where the US dollar suddenly collapses overnight. Japan has just triggered a $1.7 trillion market loss by dumping US Treasury bonds in just 72 hours. This unexpected sell-off has sent shockwaves through the financial world. But what led Japan to take such a drastic step? And what does this mean for the future of the US economy and global financial stability? Let's break it all down. For decades, Japan has been one of the largest foreign holders of U.S. Treasury bonds, playing a crucial role in stabilizing global debt markets. The country's massive investments in U.S. government securities have helped finance Washington's budget deficits while providing Japan with a secure place to park its foreign exchange reserves. However, in the first quarter of 2025, Japan offloaded a staggering $119.3 billion worth of U.S. bonds, the largest quarterly drop since 2012. This significant reduction in holdings has sent ripples through the global financial system, raising concerns and speculations about the future of U.S. debt markets. With Japan stepping back, China has now become the largest foreign holder of U.S. treasuries, marking a shift in global financial power. This change highlights the ongoing economic rivalry between the two Asian giants and raises questions about Japan's strategic move. Japan's decision to significantly cut its U.S. Treasury holdings stems from several interwoven economic and geopolitical factors. One key reason for Japan's sell-off is the sharp depreciation of the yen, which has driven up import costs and inflation concerns. To stabilize its currency, the Bank of Japan, BOJ, intervened by selling U.S. treasuries to raise dollars and buy yen, an approach Japan has used before to counter currency fluctuations. Another major factor is the rise in U.S. interest rates. The Federal Reserve's rate hikes have increased bond yields, reducing the value of existing bonds and causing losses for investors like Japan. Higher U.S. rates also make treasuries less attractive, leading Japan to reallocate capital to higher-yielding or safer assets. Japan also faces domestic economic challenges, including a national debt exceeding 260% of GDP and an aging population. With growing fiscal pressures, Japan may be repatriating capital to fund social programs, infrastructure, and economic growth. Additionally, Japan is diversifying its foreign reserves, shifting investments toward gold, European bonds, and other currencies to reduce reliance on U.S. debt amid concerns over U.S. fiscal policies and debt ceiling risks. While Japan's move is not necessarily politically motivated, it signals shifting global financial dynamics, with potential implications for U.S. economic stability and future geopolitical relations. The U.S. stock market lost $1.7 trillion in value. Treasury yields soared, making it more expensive for the U.S. to borrow. Stock market fallout. Financial markets reacted with unprecedented volatility. The Dow Jones and S&P 500 saw sharp declines, particularly in financial, technology, and manufacturing sectors. Higher interest rates increased borrowing costs, stalling corporate growth and leading investors to flee equities for safer assets like gold. The Federal Reserve faced intense pressure to stabilize markets. While some policymakers called for intervention, others warned that prolonged low interest rates had fueled instability, making corrections inevitable. Uncertainty fueled speculation and panic selling. In response, the Donald Trump administration doubled down on tariffs, targeting Japanese electronics and South Korean semiconductors. The move, intended to shield U.S. industries, backfired, triggering retaliatory tariffs and further disrupting global supply chains. Tech companies, already struggling with market declines, faced rising costs and supply delays, forcing them to raise prices. Firms like Apple, Intel, and Qualcomm saw their stock values plunge as semiconductor shortages worsened. Meanwhile, the Congressional Budget Office, CBO, issued a stark warning. Rising bond yields could cost the U.S. an additional $270 billion annually in interest payments by 2027, worsening the national debt crisis. The U.S. national debt crisis deepened as bond yields surged. Higher interest payments strained federal finances, threatening funding for Social Security, Medicare, and infrastructure projects. Foreign investors, including China and Japan, began reducing their U.S. Treasury holdings, fearing instability. This led to a declining U.S. dollar, making imports more expensive and further fueling inflation. Mortgage rates surged, making homeownership less affordable and cooling real estate markets. Auto loan and credit card interest rates climbed, cutting into consumer spending, a key driver of U.S. economic growth. Corporate borrowing costs rose, forcing businesses to cut hiring and investments, slowing GDP growth. The crisis rippled through global markets. The European Central Bank and Bank of Japan issued emergency statements to calm investors. Emerging markets faced capital outflows, triggering currency devaluations and economic slowdowns. Nations with high dollar-denominated debt struggled to service obligations, raising default risks. The Federal Reserve hinted at intervention, considering slower rate hikes and liquidity injections, though such measures risked long-term inflation. Meanwhile, Congress debated emergency stimulus, but partisan gridlock delayed swift action, prolonging uncertainty. Economists warned that prolonged stagflation, low growth, and high inflation was a real risk. Confidence in U.S. financial leadership declined, with rival economies like China positioning themselves as more stable investment hubs. Some nations even explored alternatives to the U.S. dollar-dominated financial system, challenging America's economic influence. The global economy is facing heightened instability as trade tensions between the United States and the European Union escalate. With Donald Trump's return to the White House in 2025, aggressive trade policies have reignited economic conflicts, creating uncertainty for industries and financial markets worldwide. In January 2025, President Trump imposed a 200% tariff on European wines, citing unfair trade practices and the need to protect American industries. This move devastated European wine producers, particularly in France, Italy, and Spain, whose exports to the U.S. were suddenly crippled. In response, the European Union swiftly imposed retaliatory tariffs on American bourbon, motorcycles, and agricultural products like soybeans and corn, strategically targeting industries in Trump-supporting states. The result was immediate economic turmoil, with American farmers and manufacturers experiencing sharp declines in exports. The escalating trade war rattled global markets. The Dow Jones Industrial Average saw extreme volatility, while European wineries and U.S. agricultural sectors faced severe losses. Global organizations like the WTO and IMF warned of long-term economic damage if tensions continued to rise. The conflict reached the U.S. Supreme Court, where legal battles over Trump's authority to impose tariffs without congressional approval raised concerns of a constitutional crisis. The administration's defiance of legal rulings set a dangerous precedent, further deepening political divisions. With both sides entrenched, economists warn of a prolonged trade war that could reshape international commerce for years to come. Will diplomacy prevail, or are we heading toward an economic storm with global repercussions? The global financial system is experiencing a major transformation, with significant consequences for economic stability and geopolitical influence. For decades, the US dollar USD has been the world's dominant reserve currency, facilitating global trade and financial transactions. However, recent developments indicate a gradual decline in the dollar's supremacy as alternative financial structures emerge. Declining US dollar dominance. The USD's share of global foreign exchange reserves has fallen from 61.8% in 2020 to 54% in 2025. This decline is fueled by geopolitical tensions, de-dollarization efforts, and the rise of digital financial technologies. Countries like China, Russia, and BRICS nations are increasingly trading in local currencies, reducing reliance on the dollar, especially in energy markets. Rise of alternative financial systems. China's cross-border interbank payment system, CIPS, is expanding as an alternative to the SWIFT network, while BRICS nations are working on a unified payment system. Additionally, central bank digital currencies, CBDCs, are gaining traction, with China's digital yuan already in circulation and being used in international trade. Geopolitical and economic implications. The decline of the USD limits U.S. economic influence, especially in imposing sanctions. Countries like Russia and Iran are bypassing restrictions by trading in non-dollar currencies. Meanwhile, the U.S. faces economic challenges, including a $34 trillion national debt and inflationary pressures, further weakening confidence in the dollar. The role of Japan and other economies. Japan, traditionally aligned with the US, is exploring financial diversification due to regional economic shifts. Other nations across Europe, the Middle East, and Asia are also reassessing their financial strategies, contributing to a more decentralized global financial system. With the decline of the USD's reserve share, the rise of digital currencies, and the expansion of alternative financial systems, the world is shifting toward a more multipolar economy. The key question remains: will the US adapt to these changes or risk losing its financial dominance? Share your thoughts in the comments.